Hello, hi, and welcome back to Almus Market Mornings, your daily dose of financial updates with me, Shikhar Garg. Now, quite an interesting after-market session we have had with FOMC coming in, one of the most awaited central bank meeting in the time being. And FOMC has released an update, or let's say has raised the interest rates by 25 basis points. Now, this was widely accepted by the markets, but still there was a lot of activity in the aftermarket sessions. So, JK, will you please tell us what should we expect out of the markets and how did the markets actually react with this kind of an update?
Thank you and good morning, Shikhar. Normally, a Fed move to raise rate, indicating further rises at every meeting this year, followed by balance sheet reduction plans, should have been a perfect recipe for a market crash. But what we have seen is an impressive rally, taking two-day gains for the major indices to over 4%. That really speaks for the positioning of the market, which had well discounted the move. Fed's language and Powell's responses in the presser was as hawkish as most expected, like economy strong, inflation pressure elevated and sustained for longer than anticipated, Fed ready to take appropriate measures, including series of rate hikes and balance sheet reduction to top it all, to aid the price stability. While these statements showed central banks would be in the path of real monetary tightening for some time, it was bereft of any shocks for the market and it did not rock the boat. So through their various statements recently, Fed has been, leading the market to up its own forecast for the rate rises in the year. So that is the reason why we saw market rally as well as a dollar softening a bit. Of course, the Fed's projections on the GDP has been slightly weaker. Unemployment rate remains quite well contained. In fact, up to 2023, slightly going up in 2024 to 3.6%. Core PCE is expected to be elevated this year at 4.1%, but should be moderating in 23 and come back to the long-term trend of 2% in the beyond 2024. Fed fund rates, of course, this year it's likely to touch 1.9%, followed by 2.8% rate by next year, with the neutral rate being 2.4%. But so if Fed does go according to their dot plot, they will be exceeding the neutrality rate. It's finally a message from Fed that economy is so strong that it can withstand a series of rate hikes and allow central bank to rein in the inflation, was taken positively by the markets. Apart from the Powell's statements, we also see the central bank probably being okay with slowing growth, keeping inflation fight as a top priority. Powell expected demand to slow enough to better match the supply, which indirectly indicates slowing consumption and growth. Markets read it as portending a recession, with 5 versus 10-year yields inverting. The spread between 2 and 10-year yields have hit the narrowest level of 0.22%, last seen in March 2020. Fed chief said the risk was not overly elevated to the recession. That means he is not totally ruling it out. Dollar's direction after the Fed decision has been to sell off, once again reflecting the market positioning on the long side as investors piled into the safe havens after the Ukraine war. Yen was, of course, an exception, as its differential with USD widens and no prospect of a near-term rate rise by BOJ. We look with interest the post-monetary policy press conference from the Bank of Japan tomorrow and comments, if any, on the significant weakness seen in the yen. Yen's weakness, of course, can become a bone of contention with the US authorities, who run a huge trade deficit. Gold has lost much of its safe haven driven gains, losing almost 8%, but an emerging dollar weakness will see it supported. We consider 1880-90 to be a very good level for positioning for medium term. Amid all the excitement surrounding Fed decision, Ukraine issue has gone to the background, but there are indications that the peace talks are progressing very well. This is well reflected in the European markets, which have gained almost 6% in one single session yesterday. Of course, the recovery in Chinese markets and the Hong Kong market yesterday and today is also keeping the sentiment very well upbeat. For the rupee, suddenly so many factors are working. Softer dollar index, oil correcting 25%, and of course the year-end flows. Having broken 76.30 support, way is clear for more gains. And as we have always seen in the month of March, every year, inflows will be significant from exporters and other funding sources. Good demand from oil companies should be well met by these flows. Technically, test of 75.70 looks to be on the cards. So we have a long weekend starting tomorrow. So we wish everyone a happy Holi and happy trading. Thank you.
Wonderful. So, JK, to summarize, I got some of the points wherein we see central bank did not rock the boat, and there was no much shockers from the US central bank, but they did mention that the inflation is going to be elevated for a while. They also mentioned about no hesitation to go above the neutrality rate. Now, that is a one big question, and I'd like everyone to tell their views if they have any opinion on what can be the neutrality rate. Meanwhile, like you mentioned, the 210 yields are at its narrowest since March 2020, and we have BOJ coming up tomorrow to tell or give us further updates on the yen side. Meanwhile, it's going to be a good day for you. Hopefully we have an interesting session next week. Till then, have a good time, have a happy long weekend, and happy Holi to everyone. That's it.